ARKX's flagship innovation ETFs has skyrocketed over the recent couple of years, surging more than 400% since its inception in 2014. The ETF really picking up steam last year as retail investors piled into the fund, up nearly 150% in 2020, but falling 25% in the last 3 months as a number of high-growth momentum stocks have pulled back. ARKInvest CEO Cathie Wood joins us now in an exclusive interview. Cathie, good afternoon. Thanks so much for joining us.
Happy to be here, Wilfred. Thank you.
Let's touch, if we may, on this sort of current pullback. Do you actually welcome that as a long-term buying opportunity for a lot of the stocks you love, or are you feeling the heat a little bit?
Oh, I love this setup. The last time I was on, I think I said that this rotation was good news because it meant the bull market was broadening out, it was strengthening. And the worst thing that could have happened to us is to have the market narrowly focus on just our ilk of stock, the innovation space. Instead, it has broadened out so that year to date, I think it's energy's up 40%, financials are up 27%. And from the peak, in mid-February, our strategies are down. The ones that have been hit the hardest, not all of them, are down 30 to 35%. I love that setup. From our point of view, 5-year time horizon, nothing has changed except the price, and therefore the return, which at the peak of the market and of our strategy in mid-February, we expected a compound annual rate of return of 15% on average per year from our strategies. Now that the prices are down, that number is somewhere in the 25 to 30% range.
You may love the setup, Cathie, but it hasn't been great for your business. I mean, worst start to the month on record. You've seen outflows of $1 billion. How are you managing these declines? And there's speculation out there that if the outflows continue, it would be hard to meet redemptions.
No, well, first of all, I don't have to worry about redemptions. ETFs, the ETF ecosystem is a beautiful thing for portfolio managers. I highly recommend it. So what that means is when I am making decisions, they are investment decisions. I have nothing to do with the flows. The ETF ecosystem, the authorized participants, the market makers outside of ARK, although of course we're overseeing their actions, they are facilitating our flows. And they're doing it in many ways with algorithms and derivatives. I think the ecosystem has become quite profitable for them. So we have experienced no problem. If you look at our spreads, there's been hardly a disturbance in our spreads. As far as flows, actually, we've been very gratified. I think if you go month by month now, this is endpoint to endpoint, we have not seen a month of redemptions yet. I would be, I don't want to say never. I mean, of course, we're going to get redemptions. And in fact, in the ETF structure, when we get redemptions, because of the in-kind nature of redemptions, we are able to offer a much more tax-efficient strategy or portfolio in this wrapper than we ever could have in a mutual fund.
Cathie, I wanted to dive into a couple of some of the talking points people have put out in the last couple of months. And the first one is what you would say to those people that have criticized the way in which you've held your own ETFs within one of your other ETFs. Do you accept that in the least that's not an ideal thing to be doing?
Well, this is the 3D printing fund within the space ETF, ARKX. Because 3D printing is one of the killer apps, in fact, the killer app, is aerospace, including space. We felt it very important to have a good smattering of 3D printing. Now, 3D printing is a smaller cap space. And so we felt that because it was so important that we would put it in our fund. However, our clients are not being double charged. that comes out. We do not charge them double fee. Instead, they have a very well diversified participation in 3D printing, which I think as more and more people understand how important it is going to be to aerospace, not just, you know, rockets and satellites, but also airplanes, including the engines. I think they'll appreciate why we own 3D printing and wanted to own it in size.
Whether it's the 3D printing ETF within the space exploration and innovation ETF, or a couple of the other holdings in that space exploration ETF, like Netflix, like Deere, should that ETF be called just the innovation ETF? I mean, is the space exploration part of it at the front of its title, the lead part of its title, a little bit misleading?
No, not at all. In fact, what we believe, and comparing and contrasting to the other offerings out there, which have satellite radio, satellite TV, the old world, we believe the next frontier here, where there are real money-making opportunities, is not space tourism. It's going to be a very small market in the short term. It's two markets. Mobile connectivity. There are 3 billion people around the world who have no access to Netflix, broadband, and the internet. And the satellites that SpaceX and others are putting up there now are going to give those people an opportunity to become a part of the Netflix family. So we think Netflix is going to be a huge beneficiary. Deere is probably, because of its name and everybody knows its tractors, they think it's old world, old DNA. They, for a more industrial company, they're one of the most progressive companies I've seen embracing technologies. Now, farming is going to become much more efficient. The productivity gains are going to be enormous as we start using drones to identify exactly how much fertilizer is needed, where. So I think that drones and some of the connectivity from a weather point of view, they've done for years. They bought a company from Monsanto to focus on the weather and how weather patterns would affect farmer productivity around the world. So I think autonomous farming is going to demand drones, satellite information, and so we think it's going to be a big play.
I guess the other factor I'd just throw in as well, that you remove limits on investing more than 30% of assets in a single firm and more than 20% of a single firm's shares, as well as some of those other factors that we mentioned. And I guess just bringing it all together, the broad question I had is whether, because of your fantastic inflows, it's a great problem to have, whether you grew a bit too fast for your investment universe, for your ilk of stock, as I think you said earlier in the interview, and whether at any point over that period, the last 6 months or so, you did pause and consider thinking maybe we should stop allowing more inflows and close the ETFs, close the funds, rather than launching more ETFs, raising limits, buying your own ETFs within your own ETFs, and whether that was a question you at least asked yourselves over this massive inflows.
Well, it's not possible to close an ETF, unlike a mutual fund. So that's
it's not impossible, though. I mean, you can change the rules of the game somewhat.
I do not think it's possible. I think the regulators would have a big problem with that, the way they've set the structure up, especially because of the way ETF flows are handled. Really, that's not within one firm like ours. There's a whole ecosystem around us. We went from 10 billion to 80 billion in 10, 11 months. That was pretty parabolic. And of course, we were very grateful for those flows, and we're still grateful for the flows we are getting. But that's parabolic. We are used to exponential growth. That's what we do. Our strategies, our innovation platforms, we believe are going to scale exponentially, and therefore our capacity should scale exponentially. 10 to 80 billion was a little faster than that. And so we've taken risk control measures so that we do not own too much of one stock. And you'll also see we've seen an explosion of IPOs around innovation, secondaries, SPACs are all about innovation. So we are getting more and more opportunities to scale with these newer companies participating in the innovation space.
Cathie, I wanted to talk Tesla, one of your favorite stocks, because that's part of the performance issue. It's off 25% from the highs. And there's some real questions right now about the reliance on autopilot and whether that has led to some deaths. You have been super bullish on Tesla's autonomous future and the vision of robo-taxis. Isn't that problematic, given some of the concerns here around safety?
Actually, I think we've gotten some very important information recently that Tesla is seeing its way through, so to speak, to autonomous. And that is, they've decided to take radar out of the ecosystem and just depend on vision, computer vision, CV, so 8 cameras. I think they're getting much closer. And, you know, as far as autonomous, when anyone talks about safety in an autonomous vehicle, they have to consider the alternative. The alternative is human-driven travel. Humans are responsible for 80% plus of all fatalities in automobiles. And so autonomous is going to really take that issue away from us. So we think that we're much closer than most do. We think we're probably not as close as Tesla thinks it is. But we do think within the next 2 years, we're going to see some really surprising breakthroughs from Tesla. We've been watching Waymo and Cruise Automation here, and we think they're probably struggling with how to scale that business. We think Tesla is going to go autonomous at scale or much more quickly than any of its competitors.
And then there's the China issue. They seem to be really clashing with customers on social media, the public, and the government. What do you think is going on there, and how much of a risk factor is that for the stock and the business?
Well, we do think that that China wants its locals to win. We saw, I think, just in this week, NIO. Because of the battery swap system it has, no matter what it's pricing its cars at, it's going to get subsidies, whereas the Model Y will not get subsidies in China. So there is some favoritism for locals, but we found something out very interesting this week. If you look at the drop in share of Tesla's cars in the electric vehicle space in China, what you will also see is an increase in the number of exports to Europe. And in talking to the company, we found it curious. And it seems that the quality of cars being built in China, in that super modern factory, the quality is much higher than those being built in Fremont. And we know that the European customer used to beautiful German cars is very particular about quality and design. And we think Texas will be a step up as well. So Fremont's just a very old plant. So it was very interesting to learn that. And so I think that Tesla will manage the issue you've identified and that many are discussing by exporting to the rest of the world. And I think China's going to like that. China has not been a big exporter of autos to the developed world. This will be a feather in their cap.